Hello, hello, hello. Welcome everyone to this week's live question and answer with Dave Hall. You all probably noticed we've got something unique going on today. It's Cinco de Mayo, and I am alone. CR ended up having his second COVID shot yesterday and is not feeling so well. Some of you may be able to relate to that if you've had that second shot. My wife and I got it last week. She ended up sick for a couple of days. I seem to be fine. So he's under the weather. Won't say he's in the doghouse, although he might be out in the sheep shed there with his goats and his sheep. But hopefully he'll be back next week. Looking forward always to have him with us. So I'll be trying to take care of everything today. I'll do my best to get to the various questions that you have, as well as go through the questions that we have set up from our bank of questions during our webinars. I teach 13, 14 different webinars on various retirement topics. In those, we get tons of questions, and we use this show as an opportunity to answer some of those, as well as answer your live questions. So if you do have them today, please feel free to submit those. I am going to start off today with a question that was submitted to me through email. Now, the question that was submitted through email was a little bit different than a question that I saw pop up on one of our feeds from last week's show. So I'm going to answer the first question first, and hopefully, I'm not sure if I'm going to pronounce this correctly, but hopefully Elaine's on the show today. Hopefully she'll be able to get this answer for herself. If not, I'll shoot out an email afterwards to better address the second part that came through on the feed that's going to change the answer. So the initial question was in regards to Social Security. When you have a situation where a spouse has already started taking their Social Security, they're the higher earner, so your benefits are going to be based upon the spousal benefit fit boost. What happens if you start claiming early? If they've already got into the program, they started at age 63 or age 63, and you are age 62, what's going to happen? Well, in 2015, they changed the laws to where if you're dependent upon spousal benefits, they have what's called deemed filing. And this means that if you file for one benefit, you're going to file for both. Now, if you are a survivor and you're getting widow or widower benefits, deemed filing does not apply. But when we're talking about those spousal benefits where you'd be entitled to up to 50% of the spouse's full retirement age earnings, deemed filing is going to apply. So the email that I sent back was saying, deemed filing is going to apply. If you take those benefits at age 62, you're going to have your benefits reduced for the rest of your lifetime, meaning that you will get the higher of your benefits or one half of your spouse, and then they're going to be reduced based upon their ages about 30% from there, whatever benefits you would be entitled to. Well, then I saw in the feed some additional information, and the information mentioned that the individual who had claimed the benefits was on Social Security disability benefits that they'd started at age 58. That changes the answer to that question. How does Social Security disability work with Social Security? If you're on disability benefits through the Social Security program, once you reach full retirement age, they're going to switch you over. Up until then, switch you over to Social Security. Up until then, you're going to be on disability benefits, not Social Security benefits. So if you are a spouse of an individual that's on disability already, prior to full retirement age, they're getting benefits from the Social Security program, deemed filing is not going to apply to you because they're not on the Social Security benefits themselves yet. They're getting their benefits through the disability program. So Elaine, if you're on here, I hope that helps you better understand that situation. For others that are here today, hopefully it helps you better understand how Social Security works, especially as it relates to disability, because we do have that opportunity at full retirement age to then switch over. And another thing many people don't realize when we talk about switching over from disability benefits to Social Security, that you can stop those payments if you choose to do so at full retirement age and get the extra 8% annual increase up until age 70. So that's something many people don't realize. Now, economically, it may not be possible. A lot of times when we're on disability, the income is very needed and very deserved because of what's happened physically or mentally in your life to put you on that disability payment. But you can stop those at full retirement age if you choose to do so. Today's show, we are going to be talking a lot about reverse mortgages. Now, if you have been on one of my webinars through CPA Academy or any of the other venues that we educate on, you know that I've historically taught a 1 hour class. Well, I'm changing that. I realized there was a lot of information we had to leave out because the class only went an hour. So now we've extended that to where it is an hour and a half. We've changed the title to The Truth About Reverse Mortgages, Everything You Need to Know. And in that, I talk about how reverse mortgages work, the goods, the bads, things you should be aware of, things that you could strategically use these benefits for. But through there, we obviously get a lot of questions because there's a lot of misunderstanding when it comes to the way a reverse mortgage works and how it may be able to help your retirement. We see ads out there promoting the product. One of the top questions I always get asked is how accurate are these ads, especially the one that's got Tom Selleck in it. That's the one everyone seems to see the most of. How accurate are these ads? Well, if we look at that ad specifically, what we find is that the majority of it is accurate. Now, many ads that we have out there for any product may have some misleading facts into there or some misleading statements. But as we look at that ad overall, it's a very accurate ad in the way these reverse mortgages work. But it's still an ad. It's a short exposure to what the products are. In my webinar, I go through and spend an hour and a half talking about the way these really work. So let's begin here with the first question on this topic. First question comes from Teresa. Why would credit come into play if they're using the equity in your home? So when you look at a reverse mortgage, there is a background check or a credit check that has to be done before they're going to give you that reverse mortgage. And the question's saying, well, if they're just going to use the equity in my home and that's the only thing that's going to be the collateral for this loan, why do they care what my financial history is? Why do they care what my payment history's been? Well, because what they want to be able to see is that you're going to have the money you need to be able to make the monthly payments required to keep this mortgage in place and to be able to keep your house up. You're going to have taxes that are going to have to be paid either on a monthly or annual basis, depending on how you have your property taxes set up. You're going to have to pay insurance on the property every year, and you need to have the money to pay that. If there are repairs that need to be done, those need to be paid as well. If you're in a homeowners association that allows you to put a reverse mortgage on your home, you're going to need to pay those homeowner association dues. So what they want to see really is more your recent payment history. Now, if you've got some situations from 4 or 5 years ago where you've had issues, maybe getting something paid off, or you've got some dings on your credit from 4 or 5 years ago, probably not going to affect your ability to get a reverse mortgage. But if you've got a situation where during the last 12 months, you've been late on all of your payments, you've not been able to succeed in getting everything paid off, this could be enough to disqualify you from a reverse mortgage. So something I would tell all of those that are listening, if you are looking at a reverse mortgage, don't wait until the last minute to try to put one of these in place. If you realize you're coming into some financial situations that you may be able not be able to pay your bills on a regular basis, what you want to do is try to get one of these in place prior to the point that it starts hitting your credit. And they're going to pull it up and see maybe where you've not been able to make your regular scheduled payments over the last 12 to 24 month period of time. Next question here is from Stephen. For a higher value home, can you get a private subordinate second mortgage in addition to the reverse mortgage? And I've got to educate you some. For those that have not been on my webinar, help educate you in regards to how these questions are coming and what they're relating to. The most popular reverse mortgage out there is the home equity conversion mortgage. It's backed by the Federal Housing Administration. They've got insurance on these that's going to protect you if the value of the loan exceeds the home value. But they also then have limits. And in 2021, the maximum limits in the $800,000 range for the amount of home value that can be used to borrow against for a home equity conversion mortgage. So if someone's got a $2 million home, the question that Steven's asking here is saying, if I've got a $2 million home or a home that exceeds this value, can I put another mortgage on here to take some benefit, some additional benefit from the home value that I have available? The only way you can do this is if it's non-recourse. Reverse mortgages always have to be in first position if you're using a home equity conversion mortgage. Now, there are private companies out there, and this, Stephen, may be where you'd want to look, is to look out to a private company and see if they would loan you as a home equity loan or a reverse mortgage loan, if they would loan you the total amount. So you wouldn't have to go to two parties, because it may be very difficult for you to find someone who's going to be willing to give you a non-subordinated loan or a loan where there's no recourse that you would be able to put on top of here when they know that these home reverse mortgages oftentimes can get to a point where they're going to eat up all of the equity you'll have by the time you end up passing away. But it can be done as long as the reverse mortgage stays in place first. But a better solution is to probably look out to private companies that don't have the FHA guidelines to limit the amount they can borrow, and therefore they'd be able to give you a much larger loan to begin with. Question from Eric: can your home include a rental component? A conversion mortgage through FHA, the answer is no. You cannot rent out this property if it is your primary residence. Now, they do allow for multifamily borrowing. You can have either up to a fourplex that you were renting out 3 of the units and only living in one. But if you've got one property, even if it's Airbnb, you're just renting out a room on a irregular basis where people are coming in, it's going to disqualify you under the guidelines of the loan. Now, as you go through the process, they're going to make you fill out paperwork to document what you're doing with the home. And each year they're going to have you fill out some paperwork just to verify that you're still staying in compliance with the various loan documents. But one of those requirements is that you don't rent out the home or that you don't operate a business out of the home. So if either of those are going to apply to you, make sure you talk to your reverse mortgage company before putting one of these in place so that you don't end up breaking the covenants right after putting the loan in and then end up incurring a bundle of costs to put it together and then just have to turn around and give the loan or end up giving this back or turning the loan back over and paying all those costs off and ending your reverse mortgage. Looks like we don't have any live questions yet. Feel free to submit those if you're here joining me today. I'll try to get to those as well. But in the meantime, until we see additional questions come in the chat box, let me just continue on with the various questions that we have from the webinars that we teach. This one's from Bonnie. If you must go into a nursing home, is ownership protected? This is one of the biggest challenges and biggest concerns that I have when it comes to reverse mortgages. Why is that? One of the requirements of a home equity conversion mortgage is it must be your primary residence. Well, for most people, it's pretty easy to govern whether a home's your primary residence or not. You've got to live there more than 6 months. So even if you have a second home, as long as you're living there more than 6 months, you're not going to have an issue. Well, what happens when you end up going into a nursing home? Out of your control. You have medical issues that cause you to go into a nursing home, and now you end up having to leave that primary residence. If you are married and there's another either borrower on the reverse mortgage, your spouse is a borrower, or if you were married to them when the reverse mortgage was put into place and they're a non-borrowing spouse that meet the qualifications to stay in the home, you would be able to keep that house. But if it's just you, maybe your spouse has passed away, you're a single individual, you get put in a nursing home, once you hit that year mark, you're going to be in having issues with those loan covenants. You're going to be in disagreement with those. So what's going to happen is once you submit that annual form saying that's no longer your personal residence, they're going to ask for that loan to be paid back off, and it can create issues. You may be in a position mentally or physically where the last thing you want to deal with is trying to figure out how to pay a reverse mortgage off or sell your home so you can get it paid off. So this is something you've got to be very careful with. Again, if you're the only person in the home and you've got a reverse mortgage on the property and you end up in a nursing facility for any length of time, you are going to have to probably sell the home unless you've got other assets to pay the loan off. You're going to have to sell that home, or that mortgage company is going to come in and would begin foreclosure proceedings once it got to a point where you didn't meet those requirements and you didn't settle the issues that need to be settled to be able to protect their interest and make sure that everything gets handled correctly. And one of the reasons, so why do they do this? The biggest reason they want you in the home is they know that homes that are lived in get taken care of much better than homes that aren't. Once someone's moved out of a home, it's very easy for it to be vandalized, that repairs don't get done, and therefore the value and their only protection of making sure that loan gets paid off, the value of that home can easily start deteriorating. So this is why this is one of the main loan covenants that they put into these, and that you've got to be aware of for yourself if you're going to look at getting a reverse mortgage. Sandra's question here: are both parties on the mortgage? So if one dies, the other can continue in the house? Yes. So what she's saying is if you're a married couple, why are both spouses going on to the reverse mortgage documents? Why are both spouses going on there? The main reason is, Sandra, because we do want to make sure that that second spouse can stay in the home if there's a long-term care event. If one of the spouses dies, we want to make sure that we meet those qualifications. Now, again, if you're married at the time to an individual that does not go on the loan documents and the home is going to end up going into their possession once you pass away, there are some requirements that would allow you, or some laws that would allow that individual to keep the home and for that reverse mortgage to be paid off at some other time. But you've got to make sure you meet these qualifications, because what we don't want to see is someone getting one of these in their own name. They end up getting remarried. That spouse isn't on the loan. They pass away, maybe not realizing the consequences. And then all of a sudden that remaining spouse or surviving spouse is trying to figure out, how do I deal with this reverse mortgage? What do I do at this point? How can I get this thing paid off? They're telling me I've got to move out of the home. The last thing I want to do is be moving out of this home that I've just gotten settled into. You've also got to look at it with family members. This is something else you've got to take into consideration. More and more, we're seeing families moving back in together. Well, if the primary homeowner has a reverse mortgage on that property, you may find yourself also in a situation there where if you're a child, or maybe a spouse of a child or a grandchild, that you're going to end up being forced to move out of that home so that that reverse mortgage can be paid off if you don't have the resources to just pay it off directly, if it's going to require that the home be sold. And you would have two options there. So be aware of, when we look at it, you don't have to sell the property if you've got other funds to pay off the reverse mortgage. But if you don't have the funds to pay it off, you've either got to sell the property if the reverse mortgage is less than property value, so you can get the remaining equity out yourself. Or if the reverse mortgage exceeds the property value, then you would be able to, if you chose to, just let that go into foreclosure if you were not, there's no one left signing on that loan. And then the reverse mortgage company would deal with it. There'd be no liability to the estate or to any of the beneficiaries that would receive potentially other assets that are available out there. So hopefully that helps answer that question, to where you better understand why you would want multiple people on the reverse mortgage. Rosalie's question here seems like there are more cons than pros in taking out a reverse mortgage. So really more of a statement. And for most people, this is true. When we look at the people that should be using a reverse mortgage, what we're finding is that it's only somewhere between 20 and 30% of the population should be even considering using a reverse mortgage. If you've got other assets, now there are times that you could use it as an emergency fund. Now you are going to have to pay the upfront cost to put it into place, which will be paid out of the home value. You're not going to have to pay them out of your pocket. You know, the only cost you've got to pay out of pocket with a reverse mortgage are the appraisal and a consulting fee. They require you to go through a class to make sure that you're aware of how the reverse mortgage works and what you're doing. The rest would just be added into a loan that would continue to accrue interest. So for some people, they may want to do that as a form of emergency bucket so they could access the credit line. Over time, that would increase each year if you aren't using the credit line. So the value you'd have available would get bigger and bigger. Some people may want to do that, and it can work in the right situation. But for the majority of people that are going to use a reverse mortgage, what we've got is a situation where they're usually using it as a way to help fund their retirement. It's because they don't have enough other income. Right now, we've got about 40% of the population that is living off of Social Security only. And Social Security was only meant to be about 40% of your retirement income. So we realize there's a disconnect, that the lifestyle that most people are trying to maintain, even very simple bare bones lifestyle for many people, Social Security may not be providing the income that you need to be able to allow you to cover those monthly costs. So what do many people have? They've got this home that they have built up equity in that really isn't doing them any good, because they do have to have a place to live. So a reverse mortgage may be a great option to get some additional money coming in, either on a monthly basis if you chose to use the monthly payouts, or if you're to use a credit line, maybe it's where you just pull money off each year to help you cover the various costs that would be associated with that. Now, a couple of things I will tell you when we look at reverse mortgages that I think it's important that everyone understand and everyone know, it is that you shouldn't ever use it as a place to pull it out and then put it in a bank account. I mean, right now, bank accounts are paying less than 1% interest. you're going to get charged more than that from your reverse mortgage. It's going to be probably closer to 3 or 4%. It's tied to a index that helps determine what the rate you're being charged is. For most home equity conversion mortgages, you're going to use an adjustable rate loan. Biggest reason is if you go into a fixed rate, you're going to pay a higher interest rate up front, and two, you're going to be able to borrow substantially less money against your home than you would if you were to use the adjustable rate mortgage. So for that reason, many people aren't going to choose to use a fixed rate mortgage. They'll go into the adjustable rate, which obviously has the ability to go up or go down depending upon the index and what happens. But you don't want to be pulling that money out, putting it into a bank account at 0.25% or less, and then getting charged 3 or 4% on the other end. So just be careful how you use these. Again, if for the right person, they can be a very good tool to help people get to a more safe and secure retirement, to allow them to better enjoy their retirement years. But unfortunately, there are also a lot of people out there that are trying to get you to use this equity for their benefit and not yours. And so you've got to be careful if someone's telling you how they think you should use your reverse mortgage. May not be the right thing for you to do. And depending on your trust in that person, you've got to look at that relationship and maybe see what they're trying to accomplish and what they're trying to help you accomplish. But reverse mortgages can be very problematic if people don't understand them, and that's why they require the counseling. Want to make sure that people understand these as much as they possibly can. John's question, can you simply get out of the arrangement entirely with or without having drawn any money on a credit line by paying off any amounts owed? Yes, so there are no prepayment penalties on a reverse mortgage. Now, that being said, let me talk about initial get out. You do have 3 days from the time you sign, 3 business days to be able to get out of it entirely and just act as if it never happened. Saturday is deemed a business day for reverse mortgages. So you've got to take that into consideration. If you're doing it over a weekend, you've got to include Saturday. Sunday is not included, but your initial out would be that 3-day out period that you would have if you just got signed up and then had buyer's remorse. You could get out at that point. Well, if you get past that 3 days, going to cost you somewhere between $10,000 and $20,000 on average. And I realize that's a large range, but it's going to cost you somewhere in that amount to put one of these together by the time you go through all the various closing costs, by the time you buy the insurance that's required for the home equity conversion loan, by the time you pay for it, the origination fees, all of that. Going to be somewhere between $10,000 and $20,000. That's going to go against the equity of your home and then continue to start accruing interest. So even if you set a credit line provision in here where you're not taking out any money directly, you've still got a balance of money that's growing each month or each year based upon the interest calculations and the amount that you ended up having accrued into this loan. But as long as you're willing to pay that off, that balance off, you can get yourself out of it. Another thing that many people would recommend is using the credit line as an option if you have some financial struggles. Again, it's an emergency fund. So we do see situations where people will borrow money off of it like they would a line of credit. They use the credit line, they use it for emergency expenses or what I would call shock expenses. Maybe it's even an aspirational expense. They want to go on a big trip with their family and pay for all of the trip and all the benefits of that, and then go back and pay it off over time. And you have the ability to do that as well. You can make payments at any time against the balance of the loan. Now, it is going to get applied first to interest and then fees and then principal. So you've got to be aware that you don't get a pick what it gets applied to. But if you have used credit line, you would be able to pay the loan back as well without having to worry about any prepayment penalties or any consequences of that. Lynn's question, would a credit history show whether there is an outstanding mortgage on the subject property? No. Now, it might show that you're making a payment, a mortgage payment somewhere, and it should show that you're making some type of mortgage payment, and somewhere in there it may show an address of what that payment's being paid for, what the mortgage is on. But usually what's done is a title search. So you've got a title company or an attorney that's getting in the middle of this process, and they're going out and searching the title to see if there is a lien on the property because of there being an existing mortgage. So if you think somehow you're going to get around it and they won't figure out that you've got an existing loan, because, and remember, one of the important things about a home equity conversion mortgage, they have to be in first position. So it doesn't mean if you've got a loan on your property, they can take that loan out as part of putting a reverse mortgage together, but they cannot leave that loan on there once the reverse mortgage is put in place. So if you've got a $500,000 house with a $100,000 mortgage on it, the home equity conversion mortgage, the lender who's putting this all together is going to have to give you the $100,000, and they really give it to the bank. You don't get to touch it, but it would pay off that existing mortgage that would be added to your reverse mortgage. And then you would have whatever remaining amount available to you, whether it be through monthly payment, credit line, or a lump sum, however you chose to take that money. So there's really no way around this. They're going to find that. Another issue that you have sometimes is they've got to be in front of the HOA. So you may have a homeowner association that is not going to allow you to put a reverse mortgage on your property. If that is the case, we've successfully seen people get their associations to allow a change in their bylaws and the way things are structured so that reverse mortgages are allowed. We've also seen where they say, no, we're not going to do it. And if you're in that situation, you would not be able to get a reverse mortgage on that property because you've got to be able to allow the reverse mortgage company to get in front of the homeowners association if those dues end up not getting paid. Next question we have here is from Nancy. Do you have the option to repay the reverse mortgage at any time? And we've talked about this, Nancy, and some of the others questions we've had here. The answer is yes, you can pay it off at any time that you choose to do so. Again, if you want to keep the line of credit active so that you can use it in the future, but you don't want to keep carrying the large balance, all you've got to do is just pay down the amount that needs to be paid down to get it back to zero. So you can pay it off at any time. That there are options to refinance these. Now you've got to realize that in order to do it, you're going to have to be able to get additional money out of it, and you've got a waiting period. So they do that because to refinance, you would end up having to pay a bunch of fees again. And what they're trying to do is keep unethical companies who put these in place from going out and just trying to roll these reverse mortgages over and over in an effort to make them fees and to not really benefit you on the back end. So again, can be done, can be paid off at any time. And you have the option, if you are moving out of the home, to pay it off directly or sell the home and pay it out the proceeds. You'd have some various options there. So very flexible. That's one of the good benefits about these, but it's definitely something you've got to look at from your own side to make sure it's going to be something that you would want to do. The last question we have here, we've got about 2.5 minutes to wrap things up. This is my last question, unless we get something in the chat panel. If anyone does have a question they'd like me to answer before we wrap up, put it in the chat panel and I'll try to answer it before we leave here. But this is the last question I have. What happens if the value of the home decreases and becomes less than the loan amount before the loan has been paid off? Well, one thing you need to understand, and one of the misconceptions out there, is that somehow they're going to take your home. That is not the case. And that's why we have the insurance on these properties, because the government insurance is going to step in once the final date of this loan gets taken care of. And if there's a shortage, they're going to make the mortgage company clean. They're going to be able to pay them the additional amount that the loan's grown to that the home value does not make up. So if this happens, really nothing happens. And if you're getting a monthly payment that's pushing the increase, you're going to continue to be able to get that monthly payment. It's going to continue to allow you to get that money, and the bank's going to be the one, and really through the federal government's insurance program, that insurance company is going to be the one that's going to end up having to pay that difference. So don't think they're going to steal your home if this happens. Now, if you get above that amount and you pass away, again, the family's got a couple of options. One, if they want to keep the home, there's an option to pay 95% of the home value back to the mortgage company to take possession of that home, or they can sell the home, help the mortgage company. No requirement to do so, but they could choose to help the mortgage company sell the home and get the loan paid off with the equity in the home, or they could just let it go into foreclosure and let the company deal with it. Now, obviously, if you're going to do any of these, you're going to have to move out. If there's someone in there or any assets of the person who was on the reverse mortgage, all those need to be moved out of the home, and the home needs to be vacated but you've got some opportunities there to allow that to grow. And that's one of the benefits, I will say, from a reverse mortgage, especially if you're in a situation where you think home values will be declining. Maybe an opportunity for you to get locked into an opportunity with a reverse mortgage where you can take more value out of that equity than your family may get in the end. Now, over time, real estate values go up. Right now, we've got very high values in our real estate, but it may be something that someone chooses to take the high values, believing that those values may drop down, or maybe they live in a community that's decreasing in value where they could get additional funds off of this rather than having to risk the value of their home going down and having less equity at that point. Another thing you should know, though, when we talk about reverse mortgages is you're only getting a portion of the value of the home. So if the top value, let's say, is 800 plus $1,000, you've got a $500,000 home, you're not going to be able to borrow $500,000. What you're going to do is, depending on your age, you may only be able to get access to half of this amount. And if you take a fixed loan, you may only be able to get about a quarter of the amount. So when we look at it, you need to understand, because you've got increasing interest throughout the rest of your lifetime, that your amount that you're going to have access to is definitely going to be limited from what the full value is of that property. Hopefully this has helped. If you are looking at a reverse mortgage, I would recommend you take my hour-and-a-half class. It's going to help you better understand the way these work. It's going to go through all of the good, bads, uglies, positives, things you can do, investment options you may choose to do with a reverse mortgage. If you've got other questions, we're here every Wednesday. Look forward to next week. Hopefully we'll have CR back with us. We also answer questions on LinkedIn. We've got all of our webinars. All you got to do is go to my website, theprosperityguy.com. Here you can get access to all of my educational content, as well as me. If you want to sit down with me and get questions answered on your retirement from any topic, or look at having my team and I put a plan together for you to get to a more safe and secure retirement, you can get access through our website to what you'd need to do to be able to take advantage of the no fee consultation that we're offering to answer these questions and help you better get to the retirement you're looking for. That's the show. Hope you've enjoyed it. Thanks for being with me today. And hopefully we'll have CR back with us next week. I will look forward to seeing you next Wednesday.